Wall Street did not have a lucky trading week. Now, investors are braced for another turbulent week. US inflation data will serve as a market catalyst. Before that, investors have to digest comments by Fed's policymakers. And this week, top American banks will provide their reports for the second quarter, opening a new season of quarterly corporate reports. Last but not least, central banks will continue their crusade against inflation. And this rough information background is not the best for risky assets. Wall Street did not find any relief on a Friday. Despite decent nonfarm payrolls, the benchmark stock indexes closed in the red. The Dow Jones lost 187 points or 0.55%, the Nasdaq shed 0.13%, and the S&P500 closed 0.29% down at 4,398 points. The major stock indexes traded quietly in the New York pre-market, making slight efforts to recover. The S&P 500 is expected to trade in the corridor between the same borders of 4,370 and 4,440 points. The benchmark indexes closed with losses on Friday. Investors digested the US nonfarm payrolls that looked weaker than expected employment growth, but confirmed decent conditions in the labor market. In June, the US private sector added 209,000 jobs, the smallest number of jobs in the last 2.5 years. The report calmed down traders after a massive sell-off triggered by an explosive jump in the previous ADP employment report, and the news that could have lifted risk sentiment along with the rise in unemployment was offset by a fresh indication of sustained high wage growth, pointing to tight labor market conditions. Thus, the employment data, while reflecting some slowdown in the market, proved that the ongoing slowdown is not enough to force the Fed to step on the stop pedal. At the same time, Chicago Fed President Austin Cosby said on Friday that he disagrees with his colleagues that interest rates should be doubled this year to contain stubborn inflation. But this is just one voice, slightly straight from the hawkish majority. In the corporate sector, Riven Automotive shares leaped by 14.2% on Friday, after the electric car maker reported higher than expected quarterly deliveries. US-listed Alibaba shares jumped by 8% after Chinese authorities said they would impose a $984 million fine on Ant Group. Among the sectors of the S&P, consumer goods fell by 1.3%, energy stocks grew by 2.1%, and commodities increased by 0.9%. The Russell 2000 small cap index rose by 1.2% on the day. The major indexes finished the week with losses after a strong first half a year. Over the week, the S&P is down about 1.2%, the Dow is down 2%, and the Nasdaq is down 0.9%. Futures for the US stock indexes traded mainly lower on Monday as investors showed restraint ahead of the key inflation report. This week, all eyes will be on the US consumer inflation data, which will be the last piece to the puzzle ahead of the Federal Reserve's decision in July. A report released on Wednesday is expected to show a decline in headline inflation of almost 1 percentage point to 3.1% last month. In the meantime, the week started with a deflationary news from the world's second economy. China said on Monday that producer prices fell in June at the fastest rate in 7 years, and there was no annual consumer price inflation at all. While this worries China, the statistics would help ease concerns about inflation elsewhere. U.S. Treasury Secretary Janet Yellen ended her visit to China without any significant breakthrough in the tense trade and industrial confrontation between the two economic superpowers. The two-year Treasury yield fell below 5% again on Friday and remained at that level today. However, the yield on 10-year bonds stayed above 4%. And the preliminary stabilization of the bond market, however, did not lift U.S. stocks. Index futures were in the red before the opening bell. Traders still expect the U.S. Central Bank to raise rates by 25 basis points later this month, but view a split 50-50 on the trajectory of rate hikes until the end of the year. In addition, the week is further complicated by the fact that the reporting period for the second quarter kicks off. Leading banks JP Morgan, Citigroup and BlackRock will be the first to report the earnings. Investors expect the results to shed light on the condition of creditors after the biggest crisis since 2008, which hit the banking sector. Overall, S&P500 earnings expected to shrink by 5.7% in the second quarter. Citigroup downgraded US stocks to neutral, adding that the rise in the mega-cap stocks is a set for a pullback and recession risks in the US could still be tangible. At the same time, shares of Meta platforms added 1.1%, outperforming the competitors from the top technologies brokerage firm Evercore ISI said the heated standoff with Twitter opened up an opportunity for a rival app, and Meta sized it cleverly. US-listed shares of Chinese automakers, including Li Auto and NIO, dropped by 1% and 2.4% in the pre-market after the China Automobile Manufacturers Association backtracked on a promise to avoid anomalous prices. Shaky market sentiment may receive fresh impetus and the trajectory from the Fed's policymakers. Traders will have to assess the outlook for the future of a monetary policy from Fed Vice Chair Michael Barr, Cleveland Fed President Loretta Mester, and Atlanta Fed President Raphael Bostic. The currency market creates favorable conditions for the US dollar today. Its index is trading at 102.40, 0.17% up inside the intraday corridor between 102.10 and 102.70. The greenback regained some losses today after a dismal response to the tepid nonfarm payrolls on Friday. The index decreased by 0.87% immediately. Despite sustained wage growth, the employment data gave a clue to Fed's further policy move this month. Besides, the data assured the market that the Fed's tightening campaign is coming to an end soon. Following market turbulence on a Friday, popular currency pairs are making a retracement today, and the euro slipped by 0.12% against the US dollar after a 0.7% jump on Friday, and the pound sterling shed 0.5% after having grown by 0.79% on Friday. The Australian and the New Zealand dollar incurred the heaviest losses today. They weakened in response to a decline in factory inflation and deflation in China. The Canadian dollar also reversed its trajectory today. The loonie is losing ground against its American rival, having grown by 0.2% intraday. The USD CAD pace now trading at about 1.3299 within the corridor between 1.3270 and 1.3330. Today the loonie depends on the US dollar and the oil prices. On Wednesday it will receive a trajectory from the Bank of Canada. The regulator is likely to introduce the second consecutive rate hike by 25 basis points after fresh statistics pointed to a blurry picture of the domestic economy. The data published last month showed some signs of a slowdown, with the inflation easing to 3.4%. May's employment report was poor and May's trade deficit unexpected. However, the market predicts another rate hike. Growth remains robust and the housing market is showing signs of a recovery despite 9 rate hikes so far. All this enables a conclusion about another rate hike by the Bank of Canada this week by 25 basis points to 5%. As for the oil market, oil quotes opened a new week with a decrease. Brent crude futures fell by 0.6% to trade at $77.96 a barrel. And benchmark rates rose by more than 4% last week, hitting the highest level since May and posting a second consecutive week of gains. The crypto market is trading under selling pressure. The hype about ETF is waning, but the standoff between the US Securities and Exchange Commission is in a full swing. So the crypto assets are trading with a mixed sentiment. Bitcoin is trading mainly lower today, but stays above $30,000. The token regained 0.5% to trade at 30,200 in the pre-market, and popular altcoins are trading mixed. Despite the recent flood of ETF feelings in the cryptocurrency market, JP Morgan analysts suggest that such confidence could be shaky. The report highlights that similar products in Canada and Europe have attracted only a limited number of customers, casting doubts on the long-term prospects of Bitcoin ETFs. However, despite uncertainty, Bitcoin whales remain optimistic, referring to the large holders of the cryptocurrency. Sentimental blockchain data trackers reported on Sunday that addresses holding between 10 and 10,000 Bitcoins have accumulated an additional 71,000 Bitcoins since July 17, equivalent to nearly $2.15 billion. Remarkably, Bitcoin could reach 50,000 this year and 120,000 by the end of 2024. Standard Chartered published a forecast on a Monday, and the bank predicted in April that Bitcoin could surge 200,000 at the end of 2024. Analysts believe that the so-called crypto winter was over, but one of the bank's top analysts, Jeff Kendrick, said there was now a 20% potential growth, increasing the probability and profitability of miners per mined Bitcoin means that they can sell less while keeping cash, following reducing the net supply of the tokens and pushing up prices. As for the intraday outlook, Bitcoin is accumulating momentum in the range between $30,000 and $30,500. A breakout of these borders might push the price either down to 29,600 or enable a recovery to 31,000. And that's all for today. We keep monitoring the financial market situation. Subscribe to the channel and see you online tomorrow.